Welcome to the Deep Dive. Today we're focusing on, well, really one of the standout earnings reports this quarter, nLIGHT GHT's Q3 2025 results. They're a key player in high-power lasers and directed energy.
Yeah, if you follow this sector, you know this was hardly business as usual. The numbers, sure, but also the commentary from management. It just signaled this major strategic shift.
An inflection point, really.
Exactly. This wasn't just about hitting the numbers. It felt like validation. Proof that their pivot away from the more cyclical industrial stuff towards defense markets is working. And, well, the market definitely noticed.
Right. So our mission today is to get past those headlines. We want to unpack what really drove that huge jump in margins, look at the strategy behind pulling back in the commercial segment, and examine the guidance. Does it really support this idea of sustained profit? Okay, so let's unpack this. Starting with the numbers that got everyone talking. The stock jumped, nearly 15% right after the call?
Yeah, pretty much overnight.
So, profitability first. Non-GAAP EPS hit 0.08 cents.
Right.
That just completely crushed the consensus estimate, which was hovering around a penny.
Right, a $0.07 beat. Huge. And revenue was strong, too, $66.7 million. That was ahead of consensus, showing almost 19% growth year over year.
19%, okay.
But look, if you want the single number that tells the whole operational story, it's the adjusted EBITDA. They swung from an operating loss last year, Q3, of about $1 million to a positive $7.1 million this quarter. That's massive leverage.
Wow. Yeah, that swing is enormous. It's like they didn't just turn the ship around, they fired up the engines. It speaks volumes about focus, right? Not just demand, but directing resources effectively.
Absolutely. And kind of the icing on the cake, they were free cash flow positive for the quarter too, so financially solid footing.
Okay, good foundation.
Now, what's really interesting here, I think, is the quality of the revenue. The jump in profit wasn't just about selling more stuff. It was entirely driven by the mix. They shifted focus to their highest margin business.
A successful reprioritization, as you said.
Exactly. Flawless execution on that front.
So that priority.
Yeah.
We're talking aerospace and defense, A&D.
Precisely. A&D revenue hit a record, $45.6 million. That's up 50%, 50, year over year.
50%.
Yeah. And the key detail here is what kind of A&D revenue. It wasn't just, development work. A&D product sales were the main engine here, growing over 70% year over year. That's selling actual hardware.
Okay, and that product strength leads right into the margin story everyone's buzzing about.
It does, yeah. Total gross margin jumped significantly, 31.1%, up from about 22.4% last year. But the real star, product gross margin, hit a record 41%.
41%, wow.
And management was really clear, this proves their vertical integration strategy is paying off, making those complex components, especially the amplifiers, in-house. That captures profit they used to leave on the table for suppliers.
That 41% is a huge number in this industry. Definitely validates the strategy. But let's do a quick reality check on the commercial side. A&D is flying high, sure. But the flip side is they're deliberately shedding some lower return business.
Right.
Commercial was still soft, $21.2 million, down 18% year over year.
Yeah, but that decline, you really have to see it as part of the plan. Strategic pruning. They're being very realistic, actually guiding for continued declines in that legacy cutting and welding business into 2026.
So it's not a miss, it's strategy.
Exactly. It's intentional.
And you see that discipline on the cost side too, right? They took that restructuring charge, about $1.7 million, to exit some low return stuff, mainly China and that commercial cutting welding market.
That's key because they're managing operating expenses, non-GAAP OPEX really tightly. They expect it to stay around $18 million in Q4.
So flat costs.
Right. They prune the low margin stuff, keep OPEX flat, and basically every dollar of that high margin A&D growth, it drops right to the bottom line. That's the discipline that turns strong demand into serious profit.
That is a powerful story. But okay, profitability now is great, but let's look ahead. This is where it gets really interesting, I think. You need a visible pipeline to keep this momentum going. What are the big projects, the tech flagships?
Yeah, the pipeline is really all about directed energy. The crown jewel is HELSI-2, High Energy Laser Scaling Initiative. That's the huge $171 million program for a 1 megawatt laser. Still on track, they say, for 2026 completion.
Okay, quick clarification though. That 41% product margin we were just talking about, is that coming from this big development contract?
It is, yeah, but in a really important way. The amplifier shipments into this HELSI-2 development program, those get recognized as A&D product revenue.
Okay, so it's high-value hardware sales even during development.
Exactly, high complexity, high value. And then moving beyond development, they're getting close to delivery and testing for the DEM SHORAD system. That's the 50-kilowatt short-range air defense platform.
Critical system.
Right. And they noted that getting their new generation amplifiers into higher volume production is key for future margins. They're targeting products where the incremental gross margin could be, and I quote, meaningfully north of 50%.
North of 50%. Okay. Now, you mentioned something investors were worried about.
Yeah, there is this critical detail that should ease a major concern, the potential revenue cliff.
The dreaded 2026 hole when HELSI-2 winds down a bit.
That's the one. Management was asked directly about that potential gap in the second half of 2026. And they stated quite confidently that the gap is already filled by other booked programs, both in directed energy and also laser sensing. So that removes a big overhang that might have kept the stock down before. They've apparently built the backlog to transition smoothly.
That's significant.
Yeah.
And the future pipeline isn't just that backfill, right?
Yeah.
There's more coming.
Seems like it. It's getting a boost from those U.S. Golden Dome initiatives.
Right, Golden Dome. For listeners, that's about prioritizing non-kinetic missile defense, quickly developing and deploying it, and building it domestically. Exactly. That plays right into nLIGHT's strengths with vertical integration. That push, plus growing international demand for things like counter-drone systems, counter-UAS, it really sets the stage for more high-margin growth.
Okay. And near term, Q4 guidance.
Looks like sustained profitability. Revenue guided between $72 and $78 million, call it $75 million at the midpoint, and adjusted EBITDA expected between $6 million and $11 million. So continued strength. And if we connect this performance back to the market reaction, it just makes sense. The way the company's doing versus its benchmarks, it signals something unique is happening here.
What do you mean? Like the stock performance?
Yeah, over the last 3 months, nLIGHT's total return was almost 67%.
Wow.
Compared to the SOXX, the semiconductor ETF, that was up maybe 22%.
Wow.
And the ITA, the A&D ETF, was barely up 6%.
Okay, that difference is stark. It really does scream company-specific execution, not just riding a sector wave. Absolutely. The whole narrative has shifted. It's not a turnaround story anymore, hoping for commercial to come back. This is now clearly A&D-led profitable growth, commercial recovery. That's just optionality now, a potential bonus, not the core story.
Let me push back just a bit, though. The market's seen this, right? The stock's up 67%. How sustainable is that 41% product gross margin? Is this the peak while HELSI-2 amplifier deliveries are intense? What if there's any hiccup executing those backfill contracts for 2026?
That's fair. That's the right question. Sustainability really hinges on getting those next-gen amplifiers into high-volume production, which they specifically said they're doing. And remember that target. 50% plus incremental margins. If they hit that, maybe 41% isn't the ceiling.
Yeah.
And on the backfill, execution risk is always there. But management's confidence seemed pretty high. They didn't say potential contracts. They said booked programs. So the risk shifts maybe from getting the business to delivering it. And based on this quarter, their execution looks pretty sharp right now.
Okay, fair point. Now let's get to the fun part. Our outrageous but plausible trade idea. The kind you might pitch to a high-conviction investment committee.
All right, we're calling this one the vertical integration momentum spread. The basic idea is this. Given this confirmed structural shift to high-margin A&D and the confirmation that the HELSI-2 backfill is booked, we think the market is still structurally undervaluing the stability of margins going into 2026. It still fears that old cyclical risk.
Okay, so the pitch is
establish a large, long position in SBYT. You're betting they continue to outperform the general A&D sector, the ITAs of the world, who are dealing with maybe broader budget pressures or slower programs.
Well on LEAT, okay. And the other side of the spread.
You fund that long by taking a small, short position against a pure-play commercial industrial laser company. Find one that hasn't successfully pivoted away from that cutting and welding exposure. Someone maybe still heavily tied to, say, general auto CapEx cycles or something similar.
Got it. And the rationale tying it together.
It's pretty simple, really. nLIGHT seems to be controlling its destiny here with vertical integration and deep defense specialization. They've got visibility into high-margin government revenue years out. Meanwhile, the commercial-heavy competitors, they're still stuck dealing with unpredictable industrial cycles. This trade basically exploits that divergence in execution and, frankly, business model structure. You're betting the margin gap widens even further.
Interesting. Okay, so wrapping this up, what does it all mean? Key takeaways. nLIGHT really did shed that old commercial weight, emerged as a focused, high-leverage defense tech company. Massive EPS beat, record A&D revenue, that 41% product margin, it all validates the pivot.
Yeah, and a crucial thing for you to keep watching is those Golden Dome initiatives. They aren't just talk. They represent real directives that should lead to new large directed energy contracts pretty soon in the coming quarters. Management's clearly positioning for that wave, but, execution at scale will be key. They have to prove they can deliver as these programs ramp up.
Well, thank you for joining us for this deep dive into nLIGHT HG's strategic turnaround.
Yeah.
And just a reminder to everyone listening, we're analyzing the earnings call and related materials here. This is absolutely not investment advice.
And maybe a final provocative thought for you to chew on. As this kind of directed energy tech moves from development, like HELSI-2, towards actual fielding, like DEM SHORAD, how fast can the government, the whole acquisition process, adapt to actually buy and field these new integrated domestic capabilities quickly? Because that bureaucratic speed, that might ultimately set the real pace for revenue growth beyond 2026.